Well, thank you all for making time. I understand I clash with a distinguished and very popular other speaker. So those of you in the room, thank you for choosing AVI Global. So AVI, or Asset Value Investors, we're a boutique investment manager established in 1985. So it'll be our 40th anniversary this summer. And we run three main investment trusts. We're global equity investors. So there's AVI Global Trust, the global product that I'll be talking about today. Then we've got our AJOT, the Japan Opportunity Trust. Some of you may have seen my colleague Nicholas speak earlier today. And then we've also got MIGO, which invests in other investment trusts. So we're a team of, I think, 13 people now on the investment team. Joe Bauernfreund is our CEO and CIO, and he's been at AVI since 2002, and he's the lead portfolio manager on the global strategy. I'm a senior analyst on the strategy, and I've been here since 2018. And the team, as you can see here, the team has grown quite a lot in recent years as we've built out the team both on the global strategy but also the Japan strategy. And we really have now the resource to engage with companies on a deep level. And that's something I'm going to talk about quite a lot today, is engagement and active shareholder engagement is kind of central to our approach. So this is not a particularly pithy slide, but I guess it gets the point across. We want capital growth, and we do so by trying to buy companies trading at discounts to their net asset value or to their intrinsic value. And hopefully today I can try and explain this in a pithier fashion and put some meat on the bone and explain what that means. This is a kind of another quick overview, but the trust is now about 1.2 billion of assets. And as I said, we've been running it since 1985, and Joe has been portfolio manager since 2015. And over that time period, we've compounded returns at just shy of 12% per annum. The trust currently trades on about a 10% discount net asset value. So, what do we do? As I said at the beginning, we're a global equity manager. We focus on companies from a bottom-up perspective on a fundamental long-term view. Kind of taking a step back, we're taught that global equity markets are meant to be efficient. However, we think that's not the case. In fact, we believe there are certain parts of the market that are prone to attracting structural inefficiencies. And it's these same structural inefficiencies we focused upon for the last 40 years, and we believe these will continue into perpetuity, and hence we can earn excess returns in the future. So we're really looking for three things. We want to buy durable businesses that are growing in value at a discounted valuation, and then when there's some kind of catalyst or event to unlock that value. So whilst many so-called value investors try and buy a pound of assets for 70 pence, we want to buy a pound of assets for 70 pence, where that pound can grow to be £1.10, £1.20, £1.30. And that's crucial, because that means that time is our friend as we wait for the value to correct or the catalyst to play out. And that catalyst can be many things. It can be our own activism, as I'll talk about in due course. It could be a kind of corporate restructuring or structural simplification that makes the market wake up and revalue the business. Or it could be the work of other activists or even families, if we're in a family-controlled holding company, who are taking structural steps to narrow that discount and unlock value. As I said, we think parts of the market are prone to these inefficiencies, and we can really bucket those into three main areas. At the top, you've got holding companies. So these are often family-controlled. So these are businesses that own other businesses. And what we're looking for is high-quality, durable, growing assets, so where the NAV can compound and time can be our friend. There's often kind of structural lack of research into these businesses. They're often not well covered by the sell side. And there's often investor skepticism around the family ownership. We take kind of a contrarian view. We actually like to align our capital in family-controlled businesses who we believe can think in generations and not quarters. Moving down to the middle portion, or the second bucket, closed-end funds, which I'm sure many of you will be familiar with. In the closed-end fund market, we focus on companies trading at very wide discounts to their net asset value. Often these are in the alternative asset space, so there's kind of question marks around the veracity of that net asset value and what the true NAV is. And we often look to be the largest or one of the largest shareholders in these companies, so we can work with the management and the board to unlock those discounts. And sometimes that activism spills out into the public domain, as some of you might have seen in the past with investments such as Hypnosis Songs Fund. The third bucket is Japan. So Japan has always been a market that's fascinated us. It has been a kind of a value investor's dream, but a value investor's nightmare perhaps for most of the last 30 years. Lots of companies with idle cash on the balance sheets, often swamping their market caps. But historically, there was a lack of impetus to resolve this. About 7 years ago, we thought the winds of change were blowing and corporate governance reform in Japan was real, and that led us to invest an increased portion of the portfolio into Japan. So these companies often have, as I said, significant portions of their market cap in cash, and you're buying the operating businesses on very low implied EV/EBIT multiples. And as the governance reform agenda progresses, we like to work with management teams and other shareholders to try and realize that value. So today I'm going to really talk to you about 3 examples, one from each of those buckets, and that should really hopefully bring the approach to life. So D'Ieteren is a family-controlled holding company. It's now into its 7th generation. The value lies in a 50% stake it owns in a business called Belron. You might not have heard of Belron, but you've probably heard of one of its operating brand names, Autoglass. Autoglass repair, Autoglass replace. So they are the world leader in vehicle glass repair, replacement, and now recalibration. And it's recalibration that's so fascinating. So windscreens are becoming more complex as we move to having driverless cars and more sensors in the windshield. So as some of you may know, at vast expense, if your windscreen breaks, the camera, which is fitted within the top of the windscreen, has to be recalibrated. If not, the car will veer off the side of the road. This has taken margins from 5% when I first visited the company in 2018 to north of 20% today, and they're expected to get to 25% by 2028. So this has led to considerable value growth for Belron in operating profit, which now is at about 1.5 billion euros. So this is a great, fantastic growing business stuck in what's perceived to be a kind of sleepy Belgian family-controlled holding company. What makes it so interesting is, as I said, D'Ieteren owned 50% of Belron. The other 50% is owned by private equity, where they've been selling stakes to private equity over the last 4 or 5 years. These investors naturally will want some form of liquidity event, an IPO, and it's our expectation that this will occur in the next few years. We think this is the catalyst that will make investors wake up to really reassess the valuation of Belron and as such D'Ieteren. It currently trades on about a 46% discount to our estimated NAV, and we believe the IPO of Belron can be the catalyst to make that narrow. In the meantime, we're exposed to this high quality growing business. And this really speaks to all those 3 traits we look for in terms of quality, valuation, and catalyst.
Is that 7.1% of NAV?
Yes, that's 7.1% weight in AVI Global Trust.
Yeah.
Yeah.
So that's quite a significant holding.
Yes.
The largest, is it?
No, that's the largest.
Sorry.
Yeah. Chrysalis is an example of a closed-end fund in the portfolio, a 7% weight, so just behind. Depending on where the share prices are each day, they can pip each other for first or second. So Chrysalis, many of you might know, is a London-listed closed-end fund that came to market at the end of 2018 to invest in late-stage growth companies, with the idea of being something of a crossover investor where they could hold shares in companies once they go public. At the time, I guess it held many traits that would be quite the opposite of what we look for. There was an NAV that was being bid up increasingly by SoftBank and Tiger Global investing in their assets at ever higher valuations. There were misaligned incentives with the investment manager, and there was an expensive valuation, not only in the NAV, but the shares traded at one point as much as a 20% discount to that NAV. Roll forward a couple of years, and the NAV had been written down by 40%, and the shares had gone from that premium to about a 50% discount when we were buying our shares. This, to us, was extremely interesting and perhaps highlights AVI's naturally contrarian approach. What piqued our interest was the commitment to start returning capital to shareholders and the relatively concentrated nature of the portfolio, where we could build an investment case around particular assets, such as Klarna, where we could get veracity on the NAV from where the shares were trading in the secondary market. So we felt comfortable with the valuation, and we built a significant position such that we are now the largest shareholder. I think we own just shy of 17% across our different funds. And that's put us in a strong position to negotiate with the board and speak to other shareholders to try and unlock value from the company. So as I said, we've been engaging with the board, and we've called for a continuation vote to be held next year. Quite simply for us, when a company is trading on such a wide discount, making new investments doesn't stack up comparatively well to returning capital to shareholders and unwinding that discount. So we've called for a continuation vote, and we continue to engage with the board. And this is kind of indicative of our approach to closed-end fund activism. We want to be one of the largest shareholders and in the driving seat to try and unlock value. Moving to Japan, Toyota Industries, you might have seen it actually in the news today. So Toyota Industries is one of the Toyota families. It's their original holding company, which owns a stake principally in Toyota Motor, but also owns an unlisted business. It's the world leader in forklifts, which it's a very strong, dominant business, which has generally benefited from the advent of e-commerce and higher logistics density in Western economies. So historically, it's traded a large discount to the sum of the parts, with the stake in Toyota Motor making up a large portion of its market cap, and other listed securities too, such that you were paying a very low implied price for the attractive forklift business, sometimes as low as 2 times EV/EBIT. As I've said, Japan is really undergoing an incredible transformation in terms of corporate governance, and Toyota has been seen as a kind of a bastion of resistance over the last 10 years. One of the last holdouts. This has started to change. In April this year, the controlling family have made an offer to take Toyota Industries private, and there was some uncertainty about the price at which this would happen. As of today, we've learnt the price, and it looks lower than people were expecting, and it's very much kind of an open question as to exactly what will happen next. We've already had some fellow activist shareholders come out against the proposal, but very much watch this space and see what happens. I think it's a really interesting test case for Japanese corporate governance for such a well-known company, but we will see. Certainly, though, for us so far, it's been a successful investment, but we want to make sure minority shareholders generate a fair price. Kind of flipping back out to kind of more portfolio level metrics. So, as I said, we're a global equity fund, but we look very different to the global equity market, which is very much dominated, at least in MSCI World terms, by the US, which makes up nearly 70% of that index, which is our benchmark. We have about 20% there, and kind of the corollary of that is we're very overweight Europe, where we have about 40% of the portfolio there, and also Japan, as we touched upon. So it's very much a bottom-up best ideas portfolio that looks very different to the global equity benchmark. This is the portfolio. So as you can see, D'Ieteren is the largest position at 7.1%. If there are any companies here you have particular questions on, please, they are very small text.
But you say discount, presumably discount to your valuation. Is that valuation published?
So, yeah, what do you mean?
Well, it says discount there.
Yes, it's a discount to our estimated NAV.
Do you publish a valuation or how you reach that NAV?
No. So it will depend for different trusts. So for most of these, it will be a mixture of different things. So in the case of Chrysalis produces its own NAV. So for an investment in closed-end funds, they typically have their own published NAVs. In holding companies, it's our own proprietary estimate. Yeah. So there'll be a mixture of listed and unlisted assets. And we've been modelling companies like this right since 1985, and that's one thing that's so interesting is we can look where we are in the discount cycle, which we might, if we're lucky, have a slide on, but we also might not. We don't. But what is so fascinating about where we are in the discount cycle is that discounts are very, very wide, and I'm sure you've heard this in the investment trust world, but maybe to provide some broader market context. Discounts are very wide on holding companies and very wide in Japan too. So if you look over, say, from 2004 to today, at the peak of the market in 2007, trust discounts were very narrow, about 10% on a weighted average portfolio basis. During the financial crisis, discounts widened out to just shy of 40%, and that was kind of the line in the sand they reached again during the Eurozone crisis, and again during COVID, where for in fact, a matter of days, the discount reached 45% before markets snapped back in March 2020 as the Fed came to the rescue. So what's so fascinating for us now is that discounts are just shy of the 40% level, so at levels previously observed during times of extreme market stress. And this has been a kind of a long and slow grind out over the last 12 or so months. So in a market that's been dominated by the Mag 7 and big tech, and generally a focus on US equities, the parts of the world we look at have been very much overlooked, going back to that overlooked, under-researched, and a lack of investor interest being very prevalent as reflected in these discounts. So it's very much an interesting market for us. This is our track record, as I said, since 2015 when Joe became portfolio manager. We've compounded returns about 11.5%. And that is to the conclusion where I was going to ask for questions, but we've been kind of ripping and roaring, having so much fun.